If we do see housing prices crash this year, both nationally and in Vermont where I work, it's not going to be because of foreclosures like it was back in 2007 and 2008. I think it'll be because of mass layoffs and people being forced to relocate. I'm going to talk about that in this video. I know a lot of times on this channel, I talk about how the housing market's stable and how the median sales price is likely to remain stable. And I want to be clear, that is what I think. I do think that maybe we'll see a percentage drop in the median sales price or a percentage or two gain, but there's not going to be any meaningful crash or meaningful rise in the housing market this year in terms of median sales price. That's what I personally think is going to happen. But if nothing's guaranteed, nobody knows what's going to happen in the future, and if the median sales price were to crash across the US and here in Vermont, I think this is how it would happen in 2024. Before we get into the video, my name is Liam O'Reilly. I'm a real estate agent with Jerry Riley Real Estate here in Vermont. If you have any real estate needs, both in Vermont or anywhere in the country, reach out to me directly. All of my contact information is in the description, and let's get into it here. So the first thing that I wanted to talk about that relates to layoffs and the stress that the economy is experiencing is the crisis, the banking crisis that's currently going on. Where we have this title coming out of Yahoo Finance here: top real estate CEO warns 500 or more banks will either fail or be consolidated over the next 2 years. Basically, a lot of these small and regional banks, like Silicon Valley Bank, which collapsed about a year ago, we're in March of 2024 now, hold a lot of commercial real estate on their balance sheets. And a lot of these commercial real estate loans, they're not 30-year notes. They're becoming due. The commercial real estate market values are collapsing because there's less demand for commercial real estate and interest rates are higher, which means the cap rates don't pencil out and the loans don't pencil out for many of the people holding these commercial real estate assets and the banks that hold the notes of those assets. And we're seeing further stress in the banking system in the bank term funding program with the Federal Reserve. This program started in March of 2023. It looks like March 15th, roughly. So about 9 days from when I'm making this video, will hit the year mark, which I believe is when the program is supposed to end. It'll be interesting to see if the Federal Reserve does terminate this program. But this stress that these banks are experiencing, could result in more of a systemic risk to the overall health of the financial wellness in the U.S. economy, which could lead to more layoffs. Not only at these banks. I suspect that if these banks fail or if they're consolidated, many of these banks will need to lay off some of their staff in order to stay in business or in order to merge with another company. And so that's one place where we could see layoffs, but we're also seeing layoffs throughout the rest of the country, specifically in tech, but in a lot of industries as well. Here's just a list of some major companies who have laid people off, or I guess a list of employees that have been laid off over the past year or so. And you can see that more and more companies are starting to trim down their workforce and lay people off. And how do I think this will affect the overall U.S. housing market? Let's just scroll down and take a look at a couple more companies here. Melio eliminating 7% of its workforce, One cutting 13% of its workforce, EA 5% of its workforce, Apple cutting hundreds of employees, Bumble let go 350 employees, accounting for about 30% of its workforce. So how could this affect housing across the country, but here in Vermont as well? A lot of people over the past few years have worked from home, right? The work from home craze has really shot up, and specifically here in Vermont, many people who bought homes at these higher prices have jobs that are out of state, have remote jobs where they don't need to go into the office to work. Now, if they lose those jobs and they're searching for other work, they might have to move out of state. They might have to sell their home in order to get a new job. If that's the case, and we see mass layoffs continue throughout the economy, we're in a high interest rate environment right now, which is tough on companies. And if we see more layoffs continue throughout 2024, we could see more people who are forced to sell in order to get a job and relocate for work, or if they don't have a job and they just can't make their mortgage payments, they might be forced to sell to realize some of the equity in their home, to downsize and maybe rent a smaller place at potentially a lower monthly payment. Although, if you watch my videos in the past, rent has gone up significantly. That maybe it wouldn't even be a lower payment for them. So I think layoffs are the biggest risk for. The US housing market right now, and are the biggest factor that could impact home prices this year in 2024. And it's not distressed sales. So the reason why I don't think it's distressed sales is, take a look at this. So this is out of Freddie Mac's data. I did a video about the latter part of this article here, talking about baby boomers and how their homes will be coming to the market over the next few years, and how that could impact home prices moving into the future. But when we take a look at distressed sales, people that can't pay their mortgage and are selling their home, we see that distressed sales decreased and averaged around 5% in 2023. And when we take a look at this graph, it's 5% of all homes sold in the United States. And back during the great financial crisis, that was up to almost 40%, definitely over 35% at some periods, and fluctuating between 25 and 30% of all homes being sold in the United States. So we're not seeing that right now as far as the distressed single-family homes as a percentage of all the sales in the market. And overall, people are paying their mortgages. We take a look at this chart out of Consumer Finance. This is the percentage of people who are 30 to 90 days delinquent. So these are people who missed one mortgage payment, maybe two, maybe three, but aren't completely delinquent and are being foreclosed on their property. So these are people right at the start of the foreclosure process. And we can see, based on historical levels, it's still fairly low. So most people are still paying their mortgages. We're well below pre-pandemic levels as far as 30 to 90-day delinquency rates go. And overall, people are making their payments. So if we're going to see distressed sales, if we're going to see foreclosures impact home prices across the United States, we'll need to see this jump first. This 30 to 90-day delinquent rate, this will have to shoot up to, my guess is somewhere around the 4% range. And then at that point, that's going to be a real warning sign that foreclosures are coming into the future. But they take, 6 months sometimes, or even a year, or maybe even longer, to act for these banks, for these lenders to foreclose on people who aren't making their payments. So it's a long process. And even if we see this spike up due to layoffs, due to unemployment, I don't think it's going to have an immediate impact on the US housing market. Now, if people lose their jobs, they stop making their payments, and they all list their homes, it doesn't take that much inventory to have an impact on the median sales price. We see here pending sales, they're down 8% year over year, meaning that there's not many transactions going on. And if you watch my most recent video, you'll know that new listings are up. So really, new listings are up, pending sales are down. I think that means that there's less buyers out there in the market. Now, here in Vermont, there's still way more buyers than there are sellers for homes. But if we see inventory increase and tick up because of layoffs, because people need to move, that could have a drastic impact on sales price. And a lot of these people have a lot of equity in their homes. This is the loan to value ratio across the country. And you can see that only roughly 3% of borrowers have less than 15% equity in their home. So most borrowers have over 15% equity at current prices. So even if home prices come down by 10% or so, most of these home sellers will still be above water. It won't be a short sale. They'll sell their home and have some equity to take with them. And many of them will have 50% or more equity in their home. So if we do see layoffs, if we do see people selling, we might see prices start to drop fairly quickly as people try to sell, move out of state, move somewhere where they can find a better job, and continue on with their life. So yes, there's stresses in the housing market. Yes, consumer debt is at an all-time high. Yes, credit card delinquencies are rising. but overall, we're not seeing too much stress in mortgages or foreclosures or distressed sales across the United States. So, if we're going to see a crash in median sales price here in the US, I think it's got to come from layoffs and people looking to sell their home quickly and immediately. If we do see that, then we could see the median sales price in the United States and here in Vermont start to crash. Again, this is not my base case. It's not what I am predicting will happen, but it is certainly a possibility that you should be aware of if you're out there looking to buy or sell a home this year in 2024. So I hope you guys enjoyed the video. Leave me a comment. Let me know what you think. I love reading your comments. I learn a lot from you folks. Other than that, thank you for watching, and I'll see you in the next video.